Consumer sentiment data out a few moments ago. It did miss. That's after inflation data this morning was roughly in line with estimates. Joining us this morning is Joseph Tanius, Chief Investment Strategist at Northern Trust Asset Management. And Mark Zandi's back, Chief Economist at Moody's Analytics. Guys, happy Friday. Happy end of summer. It's good to have you both. Mark, I don't know if you thought PCE was going to be the most important number for a while, but we are heading into some labor numbers. What do you make of the mix right now?
Well, Carl, I think it shows the economy is soft. Real consumer spending. It was up during the month, but take a step back, take a look at the data over the last since the beginning of the year. Real consumer spending has essentially gone nowhere. It's gone sideways, and that's before we see the impact of the tariffs on prices really translate significantly through. But we are starting to see it come through in the PCE. It's now we're getting 0.3s per month as opposed to 0.1, 0.2. So. You add it all up, it shows an economy that's soft, struggling with inflation that's on the high side of anything that anyone would feel comfortable with, and it's moving in the wrong direction. So, I don't take a lot of comfort from today's data.
All right. We made note earlier this morning of this 8K out of Caterpillar where they talked about they're guiding to the low end of the margin range because it's more tariff headwinds than they thought. Is it your view right now that tariffs will be a corporate margin story or a consumer inflation story?
Well, so I think it's going to be both. If you look at surveys of businesses as to what they're going to do with these tariffs, most businesses say they're going to pass most of the tariff increases through to consumers. So, a year from now, I'd say 2/3 of the tariff hikes are going to be borne by U.S. consumers, and then the remainder will be largely borne by U.S. businesses in the form of lower profit margins. Just a teeny weeny bit will be borne by foreign producers. So. So far it's been mostly margin. That'll probably be the case for the next few months. But, when it's all said and done, I think the U.S. consumer is going to bear the brunt.
Meantime, Joseph, I know it's just one day, but, we got the NASDAQ down 1%. Qs are red for the week. You think this is month end, or are we assembling some signs of weakness out of the likes of Dell and Marvell?
I think markets right now are trying to process just a tremendous amount of data. Of course, as we just talked about, inflation coming in, we're seeing some of that tariff pressure come through. But really, what I think markets are focused on, and Waller alluded to this yesterday with his speech, is just the very, very weak labor market. And ultimately how that's going to manifest itself in terms of the economic data. I think ultimately this really paves the way for the Federal Reserve to come in and cut interest rates by 25 basis points. Of course, everyone is just anxious and waiting to see what then happens from here on out. What is the Fed going to do, and what happens with inflationary pressure as a result of these tariffs?
Right. You think, no doubt, in fact, there were some numbers the other day looking at how core has run closer to 3 on average since the late 80s or so, closer to 3 than 2, and that in fact a 2 number is kind of aspirational. You think in today's instance it's going to be more about weakness in labor than any fears about tariff inflation?
I think, unfortunately, the Fed's dual mandates are simply at odds with one another. I mean, that's just the reality of it. And I think it's going to take some time until we see the real impact of these tariffs on inflation. We may not see the peak of that until at some point in 2026, perhaps early 2026. What we do know now, though, based on the last jobs report and, of course, the weekly jobless claims, is we are seeing some more pressure in the underlying economy itself. I think that's going to push the Fed to cut interest rates by 25 basis points. And again, I think what markets are really grappling with and focusing on is what is the path of monetary policy moving forward over the next 12 months.
Yeah, Mark, where are you right now in terms of the impact of tariffs as well? Especially because it's funny, we're obviously collecting a lot of revenues from them, but it's not clear exactly what the impact is at this point. Nonetheless, I sort of said at the top of the 9 hour this morning, we are starting to see a lot of headlines, even today or in the last 24 hours, whether it's CAD or whether it's the Gap or any number of other companies that we follow, which are talking about significant costs that they are trying to mitigate.
Well, I think the tariff effects are already evident in the weaker economy, largely because of the uncertainty that it's created. And I think businesses have become much more cautious as a result. The Fed's been cautious sitting in its hands because it just doesn't know what to do with the tariffs. And we haven't really seen the real economic consequences of the tariffs yet, but it's in train. It's coming. You can see it in the data. Inflation is picking up. It is on the high side of what I think people would feel is comfortable, and the direction of travel here is pretty disconcerting. So as prices rise, as we get more of the tariffs translating through to the higher prices, that's going to undermine or weaken real purchasing power. People's real incomes are going to come under pressure. That's going to weigh on consumer spending, which is already kind of punk. And I think that argues for an uncomfortable economy. Can we make our way through without recession? Yeah, with a little bit of luck, I think we can do it, but it's going to be very, very uncomfortable here over the next 6, 12 months. So, yeah, I mean, you're right. We haven't seen the real economic consequences of this policy yet, but it's in train. And by the way, it's not just tariffs. It's immigration policy, which the brunt of that's being borne by the labor market. And it's not at all unlikely that we're going to start seeing some job loss simply because, there's just no labor force out there. So it's both policies, tariffs and immigration. Yeah,
we did some coverage this morning about layers of middle management. Google's a good example, getting stripped as that ladder flattens a bit, and we think in part because of technology. Guys, have a good long weekend. Come back soon. Joseph and Mark, thanks.